Okay. Yeah. Right, a very good evening. Students, am I audible? Hassan?
Yes, sir.
Perfect. Today is our first revision session for AFM, and we'll be focusing on key areas that are quite complicated in the exams during our sessions. So your pre-mock for the June exam was released a couple of days ago. And in this, we'll be looking at the question that was targeting foreign exchange risk and interest rate risk. So as you can see in the first question, that is section A. For 50 marks, they have targeted areas on business valuation and acquisition. It's basically project appraisal. Section B, first question is on adjusted present value. Again, back to investments. And the final question is on interest rate risk. Okay. Two exhibits. First is on risk, second is on interest rate risk, carrying a total of 25 marks. Let's work on this question for today's session. So first, go through the requirements to have an understanding of what the examiners test. All right. So part A, calculate in percentage terms the results of the hedging strategies that are being considered for the $36 million loan. If the central bank base rate increases to 4.4%. Your calculation should demonstrate the rates at which payments between counterparties should be made. Total of 11 marks for computations. Part B, comment on the results of a calculation in A and discuss the advantage and drawbacks of a stock wave company of interest rate swaps compared to traded collars, including a consideration of the risks involved. 9 marks theory. And the remaining 5 marks is for displaying your skills in analysis, writing, and reporting. All right. So based on the requirement, we can see that they will be taking a loan. We'll be taking a loan of $36 million. So we'll be taking a loan in dollars amounting to 36 million. If the central bank base rate increases to 4.4, since they're testing interest rate risk, so we'll be borrowing in a future date. So on that future date, at the time of borrowing, the central bank base rate will be 4.4%. So look at interest rates. We do not know the spot rate, but we know the future spot. At the time of borrowing, the rates will be 4.4%. Good, that's it. So how many hedging strategies have they given? First exhibit, okay, all right, a small description. Let's see what have they provided. Stockwave Company's risk management. Stockwave Company is a large cosmetics company. So when they're cosmetics business, its treasury department uses a variety of derivatives regularly to manage interest rate and commodity price risk. Stockwave Company's chief executive has been considering how the treasury department uses derivatives. She understands that the purpose of derivatives is to hedge risk and wants to be sure that using derivatives avoids financial risk as far as possible. Exhibit 2 is where our information is present. Right. Today's date is 1st of April. So spot date is basically 1st of April. Today is April 1st. Stockwave company, so we are Stockwave, plans to borrow an amount of $36 million that we have noted on 1st of September. So from today to 1st of September, month of April, May, June, July, end of August. So after 5 months, April 1st to April 30th, May month, April, May, June, July, August end. So 31st, 30th of August means 1st of September. So after 5 months, we'll be borrowing 36 million to finance a major product development. So this loan, so at the time of borrowing, right? So if future spot is also given on 1st of September. This loan will be for a period of 5 months. Okay. This loan time period is also for 5 months. Okay. The loan is taken for 5 months. Okay. Although in recent years, Stockwave company has borrowed for periods between 1 and 3 years. That's what their usual borrowing is. Stockwave company's treasury department has decided to hedge the risk associated with this borrowing, as there is some uncertainty about how interest rates will change over the rest of this year. They are hedging because of interest rate uncertainty, interest rate risk. The current central bank base rate is 3.9%. So current spot rate is how much? 3.9%. Most predictions in the media suggest that it could rise by 0.5% by 1st of September. As you can see, when 3.9% increase by 0.5%, you get 4.4%. So which is given in the question itself, 4.4% on 1st of September. It's also in line. Although there have been a couple of predictions that the central bank base rate will fall. Future cannot be 100% predicted. So there can be different outcomes. The most expected is 4.4%, but there are also possibilities where future spot rate can reduce. That's there. Stockwave company can currently borrow funds at a floating rate of central bank base rate plus 60 basis points. So if Stockwave wants to borrow, if we are going to take a loan, we can take it as the base rate plus 60 basis points. 60 basis points means 0.60%. Right? So if you are taking the loan today, it becomes 3.9% plus 0.6%, 4.5%. If you are not hedging and taking the interest rate after 5 months on 1st of September, it's 4.4% is the spot rate, central bank rate. You have to pay additional 0.6%. We can borrow for 5%. Stockwave company's treasury department is considering hedging the interest rate risk by using, there are two methods, an interest rate swap arranged through Stockwave company's bank. So you might go for an interest rate swap. A collar on options on interest rate futures. Students, so far our usual question comes in options. Now see options with a collar. I hope you can remember the different types of options. Okay, cap, floor, and collar. Collar is basically where we set up both a maximum and a minimum rate. Okay, options with collar. Right? You are aware that when it comes to interest rate cap, if you are borrowing money, we go for interest rate cap, where we can set up a maximum limit of interest. If you are depositing money, we go for interest rate floor, where a minimum interest is guaranteed. If you're going for interest rate collar, you take both a cap and a floor. Then you get a collar. So when you go for options, you have to take both put option and call option. A normal option, we will go for either put or call. Interest rate option. If you are borrowing money, you have to buy put options. If you're depositing money, you'll buy call options. That's what usually happens. But in a collar, you go for a collar is consisting of both maximum and minimum rate, interest rate cap and interest rate floor. So we purchase both put and call options at the same time, right? Collar on options is the most important term here. Now let's look at the swap first. Stockwave Company's bank has found a possible counterparty for a swap with Stockwave Company. The counterparty can borrow at an annual floating rate of base rate plus 140 basis points. So going with the counterpart, so they can borrow at base rates plus 140 basis points. 140 basis points means 1.4%. So we are having the advantage. What is the difference? 1.4% minus 0.6%. 0.8%. Students, give me a minute. There's a call for prayer going on. Let's take a minute break. All right. So where were we? All right. The counterpart can borrow at an annual floating rate of basis rate plus 140 basis points. So base rate is basically the actual spot rate of the market, or a fixed rate of 5%. Counterpart can either borrow with the rate or a fixed rate of 5%. Stockwave Company's bank has quoted it a nominal fixed rate of 4.7% for it to borrow. If we are borrowing at a fixed rate, the bank would provide at 4.7%. So it's understandable, right? Our interest rates are low because possibly our company risk is low. The counterpart, if they're going for a variable interest rate, they have to pay 0.8% more. If it's fixed interest rate, counterpart has to pay 0.3% more. Makes sense. Higher the risk, higher the return. higher the risk, higher the cost. So this is how it is. The bank would charge a fee of 10 basis points to each part individually to act as the intermediate of the swap. Normally, swaps are done by a company and another party, but now the swap is done through the bank. So the bank has a separate charge. Oops. So bank charges. 10 basis points means 0.10 percentage. Bank charges from both the parties. Both parties would share equally the potential gains from the swap. Swap gains will be borne equally. Now tell me, students, swap, we first have to decide which party will take the fixed rate, which party will take the floating rate. In both the options, our company has the better rate. Floating rate, we are having 0.8% lesser than the counterpart. Since you are going for a loan, you have to pay interest. Fixed rate, we are cheaper by 0.3%. So we will have a better option if we take the option with the highest gain. So we will go with the variable rate plus 0.6%. Why? If the counterpart takes that, an addition will 0.8% additional payment is done. So to save this, to gain, we are going with this. Since we are going with the variable rate, the counterpart will select the fixed rate. Okay. So see, since we are going with this, we will be earning $0.8. Since the counterpart is going with fixed rate, we could have borrowed at 4%, counterpart is borrowing at 5%. So there's a loss of how much? There's a loss of 0.3%. And bank charges, this 0.1% should be paid by both the parties. So due to the interest rate swap, an additional 0.2% charge is paid. So what is the net gain? The net gain is 0.3%. The net gain is 0.3%. And they are specifically stated, both parties would share the potential gains, share equally the potential gains from the swap. So each party will gain how much? Hassan, once we have completed this question, we'll understand why both the parties would be interested in swaps. Okay. So the potential gain by each party, gain by each party is how much then? 0.3% divided by 2 equally. 0.3% is the total gain. So gain by each party is half of that, 0.15%. So remember we discussed interest rate swaps in class. Okay. But the only difference in this question is in the class, there was nothing called bank charges. Here there are. Right. So let's look. So this is the gain. So if you want to really understand how things work, see, loan taken at, we are going with the base rate. Counterpart is going with the fixed rate. Right. And the actual payment is, we are paying. So now once we take the loan, now we are swapping it off. Minus 5%. We are paying 5%, and then the counterpart gets 5%. Okay. On the other hand, counterpart pays the base rate. Minus. I write it? Okay. Okay. Let's put in brackets. Okay. And we receive the base rate. Right? And then comes the bank charges. Good. Right. And if you look at how the examiner has provided this, see, the examiner also has stated stock wave, just like what we did. V, if you're going for fixed rate, is 4.7, variable rate base plus 0.6. Counterparty 5%, base rate plus 1.4. And there's interest rate differences 0.3 and 0.8. Stockwave company has an advantage in borrowing at both fixed and floating rates. But which will give the better option? Borrowing at a floating rate. Why? There is a 0.8% advantage. So gain for Stockwave is minus. So the total gain is 0.3. 50% of it belongs to Stockwave, 50% belongs to the counterparty. So it's 0.15%. So we have done that here. So this would be sufficient. Okay, so if you want to go into detail, if you are going with a swap, okay, so there are two types of workings given here. The first working is more straightforward. So see, we discussed the loan, we are taking the loan at variable rate, counterpart is taking the loan at fixed rate, and then we swap. We are paying the counterpart's 5% interest, counterpart pays our variable rate. As you can see, base rate plus 0.6% is what we are borrowing at. Counterpart borrows at 5%. Okay. And the actual pay is minus 5%, but however, this is after reducing the gain. This is after reducing the gain. Right. Let's look at a separate working. Okay. So the most simplest working is, you ignore this. So you know that we are selecting the base rate, and this interest will be paid by the counterpart. The counterpart is selecting the fixed rate, and that will be paid by us. So guys, see what is our net impact? Net impact is, since we took the variable rate which is paid by the counterpart, and at the end of the day, our actual expense is we are paying the fixed rate. So the interest rate that we pay is actually, we are paying a fixed rate of 4.7%. Counterpart will be paying base rate of 1.4%. Okay. And what is the gain from swap? Gain is 0.15%, both parties. So what is the net interest pay? Fixed interest of 4.7%. But now we are having a gain of 0.5. Our expense will only become 4.55%. Counterparty. Earlier, they paid base rate plus 1.4%, and now they are saving 0.15%. So now their expense will be base rate plus 1.25%. So this will be the net impact. Okay, so they say they want the answer in percentages. We computed the gain percentage, which is 0.5 each party, right? Others interest is paid by us. We took the variable rate, the other party took the fixed rate. So we pay the fixed rate, others interest. Our interest rate is paid by the other party. So they pay variable rate. So counterpart pays the variable rate of base rate of 1.4%. That's the interest. 4.7. And if you adjust the gain, this is our net pay. As we did in the first computation, you can see each part will have a gain of 0.15%. Now this answers your question. If we have the advantage in both fixed and variable, why should we go for an interest rate swap? See, if we do not swap, we will pay a fixed rate of 4.7%. After swap, we will pay only 4.55%. Counterpart, if they do not swap, they will have base rate plus 1.4% interest, but now base rate plus 1.25% interest. So that's how the saving is. Now you can ask, sir, why should we go with the fixed rate? Why not we go with the variable rate? We don't know what will be the future base rate. So that is that uncertainty. So rather than going with unknown uncertainties, if you go for interest rate swap, there will be some gain for each of these parties. So we can do it in many computations. This computation is quite easy. Good. Right. Next is collar. So collar is not your usual option. This is where we go for a collar, both a cap and a floor. We go for both call and put, not one. Options on 3-month September dollar futures. September futures. It's 3 months. Keep in mind, September futures means it's expiring in September. When is it? End of September. September 30th. Okay. But remember earlier we discussed, we take the loan on 1st of September. Okay. But here, September futures means 30th of September. So there's a 1 month difference. $1 million contract size. So contract size is $1 million. Option premiums are in annual percentage. So there are two strike prices. 96 is for call option, 95.5 is for put option. And the premium is in percentage. So this is 0.219 percentage, 0.234 percentage. Right? Strike price 96, 95.5. So if you convert the strike price as an interest rate, what is the interest rate we are going with the strike price? It's basically 100 minus this, 4 and 4.5. Okay, 4%, 4.5%. In terms of premium, call option 0.219 percentage, put option 0.234 percentage. So this is the detail. The current 3-month dollar future price for September futures is 95.62. Okay. The current 3-month future, the opening futures is at 95.62. So going with interest percentage, how much is it? 100 minus 95.62. 4.38. 4.38 percentage. Futures and options contracts are assumed to be settled at the end of each month, the end of September, maturity date. Basis is assumed to diminish to zero at contract maturity at a constant rate, based on monthly time intervals. It is also assumed that there is no basis risk and there are no margin requirements. Students, when is today? Today is 1st of April. Okay. So if you are signing, if you are buying futures today, if you are opening futures today, if you are opening futures today, today is what? 1st of April. Your future price is 95.62. Today, what's your, these September futures, right? Today, what's your spot rate? The spot rate is 3.9%. All right, 3.9. If you look at the difference between these two, what's the difference? 0.48. This 0.48% is what? This is the basis point, so basis risk. Basis point is, so basis risk is 0.48. Today, if you are borrowing a loan, we pay 3.9%. Today, when you are signing a futures, it is 4.38%. So there's a difference of 0.48%. So this future ends when? It's a September future. So from 1st of April, this future is expiring on September 31st. April, month of April, May, June, July, August, September, 6 months. Okay. So basis points per month is how much? 0.48 is for 6 months. So during 6 months, it automatically will, the gap will reduce by 0.08% per month. However, when are we taking the loan? Loan is taken on September 1st. As at September 31st, as at 1st of April, your basis point is how much? 0.4 today. Your future maturity, future ends when? September 30th. Basis point is how much? 0. Loan is taken on 1st of April, 1st of September. So from 1st of April to 1st of September, 5 months are done. 1 month is remaining till it is 0. So what is the basis points at this time? 0.48 is for 6 months. 1 month remaining. There is a 0.08 basis points remaining as at 1st of April. This is called unexpired basis risk. Got it? Today, 1st of April, we are going for September futures. So as at 31st of September, this basis points will be 0. So it has for 6 months. So each month, this basis risk will reduce by 0.08%. But taking the loan on 1st of September, but the future ends on 30th of September. So there's 1 month gap. So when you're taking the loan on 1st of September, there is a basis risk of 0.08%. All right. Good. Right. So these are the workings we can do so far. And students always follow the set of steps I had shown. First step, are you going for call option or put option? Normally, since it is a loan, we will have to go for put option. But here is a caller. Options with caller. So we are going with both the put option and a call option. Both is done. You know what is the call option strike price? Put option strike price. You know both of these as well. That's why they have stated buy September put options at 95.5. for 0.234% premium. And September call options at 96 for a 0.219% premium. Okay. Number of contracts. Number of contracts. Students, you know, the amount we have to borrow is 36 million. Size of one contract is 1 million. Where is it? Here. So there should be 36 contracts. But from today, we are taking the loan after 5 months, from 1st of September to 1st of April to 1st of September. There is a 5-month gap. Today is 1st of April. We are taking loan on the 30th of 1st of September. So 5 months. However, the futures is for 3 months. The future is for 3 months. As you can see, futures are typically ending every 3 months. And this September future they have given us is also 3 months. This is not a 6-month future. Right? So it's basically we need 36 million. Size of contract is 1 million. And a normal contract goes for 3 months. But we are borrowing after 5 months. So it's 60. Okay? 60 contracts. And the basis points, we have computed 0.48. We have computed basis points, which is 0.48. And we also computed the unexpired basis risk, which is 0.08. Basis 0.48%. It's 48 basis points. Unexpired basis 0.08% or 8 basis points. 60,000, yes. So we have to borrow 36 million. Size of a contract is 1 million. So normally we need 36 contracts, but each contract is for 3 months, valid for 3 months. But we are borrowing after 5 months. So we have to hedge until September end, 1st of April to 1st of September, 5 months. Divided by 3 months. 3 months is the maturity date of a futures contract into 5 months. Keep in mind, if we don't do this, that means if we buy only 36 contracts, 1 million is the value of one contract. If we buy 36 contracts, yes, we are hedging 36 million. But this expires after 3 months. Expires after 3 months. When I borrowing after 5 months. So from today for 3 months, we can hedge. What about the 4th month and 5th month? We again have to buy a set of futures. So you need to know how much to buy. 60. Okay. Next is now we have to go to the exchange and pay the premium. We are going for both a put option and a call option, right? Both a put option and the call option. And here is your premium, right? No, since this is a borrowing, normally when we are borrowing, we have to go with the put option. Go with the put option. What is the premium? 0.234. However, we are also going for call option. So even though premium is an expense, normally if we take put option separately, call option separately, we pay premium. Put option, we pay premium. Call option, we pay premium. Because why? The premium is the additional fee we pay for the option service. But now it's a collar. We are taking both put and call. So it can be netted off. Can be netted off. How much? We are going for a 1 million contract. And that 1 million contract, we are buying 60 contracts. And each contract is a 3 month. So your premium expense is 2,250. Okay. For put option, we are pay 0.234% premium, call option 0.219%. Net it off. We are paying the premium for the different options contracts. Each contract is 1 million. We are going for 60 contracts. We are going for 60 contracts. And the duration of a contract is 3 months. Right? If you are taking a put option separately, call option separately, premium no need to divide by months. We just pay premium on the value of the futures. But here, when it comes to interest rate collar, you will have to do this. Right. Good. Next is, what is the futures price? Now we have got the futures price right here, 4.4%. Okay. However, there is also unexpired basis. As of 1st of September, there is unexpired basis of 0.08%. Convert percentage. Ooh. Let me divide by 100 again. Okay, 0.08%. Okay. So what's your, since you are borrowing, you have to pay interest. What's your total payment? 4.48%. This is what the examiner has given as 100 minus 4.4 minus 0.8, 95.52. So 95.52 means how much? 100 minus 95.52 is 4.48%. So this is your futures price. This is your futures price. And now we're exercising it. Your futures price is 95.52, 4.48%. Okay. Now, since it's an option, you have to decide whether to exercise the option or lapse the option. So we are going for both put option, call option, and put option. What is exercise price? Call option 4%. 96 means 4%, right? Put option 95.5 means put option it is 4.5%. So what these are percentages. Right. What about the futures price? Futures price we have discussed 4.48%. Right. Now tell me, students, what would you do? Now keep in mind, put option is when you borrow. Put option is when you borrow money. Call option is when you deposit money. Now tell me, students, if you are depositing money, obviously do you want a less or high interest? We want a higher interest income. When you're borrowing money, when you borrow a loan, you have to pay interest. So you'll always want to pay less interest. So in both of these situations, the futures price is better, okay, than the future spot trade is better than the exercise price. So since the exercise price is bad, we will lapse the option. Why? This exercise price given 96.95, 4%, 4.5%. That is very disadvantageous to us. So we will lapse the option. Right? So this is what is given in this. So if you are looking at what's the final impact, your borrowing cost. Your borrowing cost is how much? 36 million borrowed at future at 4.4%. On top of that, we have to pay 0.6%. Why do we pay 0.6%? Because when we are taking a loan, we have to pay base rate plus 0.6%. Okay. Since we are lapsing the option on September 1st, we do not agree with the option. We are going with the market rate. We are going with the market. Is if you are going with the options. Okay. Yeah. So what's your borrowing cost? We are basically going with the market rate. Right? Since you are going with the market rate, no need to think about options. 36 million is borrowed at market rate is 4.4%. On top of that, we have to pay 0.6% premium. Okay. And we are taking for 5 months. The loan is needed for 5 months. These are normal expense. Right? 750,000. Premium we have already paid. So we can't. Premium we have already paid. How much have we paid premium? 250. So keep in mind all of these expenses. All of these expenses. Your borrowing cost is also an expense. Interest expense. Premium is also an expense. Okay. So what's your total pay? 752,000. 752,250. Since they want to get this payment as a percentage, total pay as an annual percentage, we are paying 752,250 for a loan of 36 million. Okay, and this interest is paid only for 5 months. How much is it for 1 year? 12 months. So the interest is 5.02%. 5.02%. And now see, if you are going with the part B, you have to comment. Part B, if you are going with interest rate swap, what's your expense? The net expense is 4.55%. Okay. If you are going with option, yes, we are lapsing the option, but still, what's your expense? 5.02%. So these are expenses, right? Right. Why do we take 4.4 and not 4.48? Where do we have 4.48? Let me check. Let me check. No, see, guys, see, 4.4% is your future spot interest rate. And you know, this is your future spot rate. Future spot. And this is your, and you know that on 1st of September, there is 1 more month for 31st of September. So between the spot rate on 31st of September and the futures price, there will be a 0.08% difference. So spot rate is 4.4% on September 1st. Future spot rate is 4.48%. And now, students, here we were comparing the options. Here we were comparing the options. Okay. I'm in a class, ma. Okay. When including unexpired basis. So see, on 1st of September, on 1st of September, this is your future spot trade. Okay, now these, be careful with these terms. Future and future spot is completely different. 1st of September market trade is 4.4%. And 1st of September, the spot rate is 4.48%. That's the difference. Okay. And next we took the decision here. The exercise price is given 4 and 4.5. That's the price at which you bought the call option and put option. Strike price. Okay. Premium. Premium. Hold on. C26. Yeah. Good. This is it. So part B, what do you recommend? So if you're going with interest rate swap, your interest expense is 4.55%. We discussed. Fixed rate 4.7, we'll be having a gain of 0.15. Net pay is 4.55% for us. 4.55%. If you're going for an option, yes, we will not exercise, we'll lapse the option. However, with premium, there will be an interest pay of 5.02%. So you will select or you will choose the interest rate swap, the lesser interest expense. This is your part B. Right? This is your part B. Comment on results of the calculations and discuss the advantage and disadvantage for stock wave of interest rate swaps compared with trade collars, including a consideration of the risks involved. So first one is, yes, you have to comment on the results. You can comment on the results by discussing these numbers. Interest rate swap is your expense. Option, yes, you will lapse the option based on the forecasts. However, after lapsing the option, you will have an annual interest expense of 5.02%. You will select interest rate swap based on the numbers. And now you have to comment on the advantage and disadvantage. Option has a unique advantage we have discussed. What's the advantage? You have a choice. If things go well, you select. If things go bad, you ignore. You can exercise and lapse the option. And option, the advantage is that because of that, if the financial market is very turbulent, if the financial market is very dynamic, not stable, option will give us a buffer. Why? If things go really bad, we have the option. We can make the choice to ignore or select the particular option, the contract. But interest rate swap, there is no such thing. Sometimes, depending on the movement of the future market rate, if things go bad for us from the interest rate swap, now see the amount of, we don't have any choice. We are contracting with another party, swapping the interest rate variables. Okay, so that's the advantage of option and disadvantage of swap. Right? What is the advantage of swap? Advantage of swap is basically where it's very customizable. Now let's say you want a loan of 3.5 million. You can exactly find a party and hedge exact 3.5 million. But option contract sizes in options. You have to be very careful with that. 3.5 million, let's say a contract size is 1 million. So how to get 3.5 million? You can't take 3.5 contracts. You have to take 4 contracts. Those are the major pros and cons from interest rate swap and options. Let's see what else have they provided. The calculation suggests that a swap should be chosen. We discussed with numbers here. However, the collar may give a better result if base rate fails. Yeah, we have a choice. If base rate falls, we have a choice. So directors may choose the call if they believe the predictions that base rate will fall. It would be helpful to determine at which rate the collar. So all of our computations were done assuming that the future spot rate will be 4.4%, the future base rate or the future market spot. But if that changes, collar would be more secure because we have a choice. Advantage of swaps. Stockwave company is swapping their a commitment to pay a variable rate of interest that is uncertain with a guaranteed fixed rate of interest. Right. As swaps are over-the-counter arrangements, they can be arranged in any size. We discussed. You want 3.5 million, you can exactly find a counterparty exact hedge exact for the specific value. In futures options, it's all contract size is fixed. There is a risk that not all amount borrowed will be hedged. That's another risk. How, for example, let's say we want to borrow 3.5 million. We found a counterparty, that guy is only borrowing 3 million. So we have to agree with 3 million. 0.5 million might not be able to be hedged because we can't find someone else. Disadvantages, swaps are subject to counterpart risk. So swaps and options you can compare. Swaps, we are subject to counterpart risk. Options, no. If there's a risk in counterpart with the bank, we have a choice whether to accept or reject. As stockwave companies swapping the fixed rate commitment, it's 4.7%, there's a risk that it will be committed to higher interest payments than it could have been. It cannot take advantage of favorable interest rate changes as it could to some extent if it is used as a cover. As swaps are over-the-counter instruments, they cannot be traded or allowed to lapse if they are not needed. If, for example, stockwave companies' borrowing strategy changes, the options can be traded on the derivatives market. So it's all based on what's happening in the future market. Keep in mind, swaps, once you sign off the contract, you must follow the contract. We don't know how the future market will change on 1st of September. When you're actually borrowing, we do not know what the market rates will be. But the main advantage of option is, yes, we can either exercise or lapse. But the disadvantage of option is additional premium should be paid up. So, these were what was discussed in this paper. Right. Good. Previous question was on APV calculation and evaluate whether the investment should be accepted or not. 13 marks. Discuss the factors which will influence fluff-tech companies' credit rating. 7 marks, students. You can discuss general factors, but always try to take factors from the exhibit. You know what credit rating is? Credit rating is done by credit rating agencies, which are independent organizations that basically provides a rating reflecting the risk of the company. So what factors will affect the risk of the company? Speak about those. You can take factors from the example, and you can also bring up outside factors. 7 marks is quite a lot. Evaluating the extent to which these will also be important to shareholders. Those factors and its importance to shareholders. Profitability, payment on time, their previous transaction processes, their bank balance, assets, all of this can be discussed. Take a look at the suggested answers for in-depth understanding of their theory. And in terms of section A, the requirement was prepare a report. So report format can take a simple format, to, from, subject, date, and then make sure each para is relevant. Introductory para, body should have subheadings, and then you have a final conclusion. Calculate the profit or loss on the sale of infrastructure support division. 2 marks, so it should be a basic computation, profit or loss. Not cash flow, it's profit or loss. Calculate the percentage gain or loss to shareholders of Tinselton company under both the scenarios of all shareholders accepting the cash offer and shareholders accepting the share exchange. We had discussed this previously in the classroom. When we acquire, so we'll have to either pay or we'll have to pay cash for the shares, or else for the subsidiary shareholders, we take their shares and give our group share. We had discussed both of this scenario. We also discussed what is the minimum value the subsidiary shareholder will demand and what is the maximum value we will be able to provide. Remember synergetic benefit? Work on that. Conclude solely on financial grounds whether Tinselton company shareholders will accept the cash or share exchange offer. 18 marks. This is a very easy area. Discusses the problems with achieving the forecast operating synergies from the acquisition and the steps which Walrich company's board can take to achieve the synergies? Theory, 8 marks. Problems in achieving the forecast operating synergies. My goodness, all of these are estimations. So you have to discuss factors that will cause these estimations to not occur. Internal factors, macro factors, you can easily take any of these from the acquisition. Simple example, a generic answer is you are acquiring a company and want to gain synergy. Both of you are in the same line of business. What are the problems? For example, differences in culture. You acquire the other company and want to merge the company, but see the culture, there is cultural incompatibility. Where now it causes harm rather than any synergy. Okay. So you can discuss many of these problems. See, always prioritize data given in the exhibit. If there is no sufficient data given in the exhibit, you can discuss these general situations, but always make sure you simplify this and explain in a very simple manner so that anyone can understand. And steps which Walrich company's board can take to achieve the synergy. What are the several suggestions you provide for the company to achieve synergies? Discuss for both the share exchange and cash offers, the impact on Walrich company's financial situation of purchase of Tinkleton, likely reaction of Walrich company shareholders. If you're going for share exchange or if you're going for purchasing the shares by cash, what will happen to financial situation? If you are going for cash, we'll have to pay money. Our cash balance will be reduced. Sometimes if we don't have enough money, we'll have to take some loans. So there'll be increased liability and or else reduced assets. Or share exchange, there's no impact on the financial situation. The only thing is they are providing more shares. Number of shares that have issued will have increased, right? If the number of shares have increased, see, when we issued shares, we don't receive any money, right? And the likely reaction of Walrich company shareholders. Think you yourself as a shareholder. If cash is paid, it doesn't matter to you. But if you release more shares to new shareholders, that will affect the share price. So we'll have a quick chat on that area. Discuss the ethical considerations from Walrich companies and Tinselton's companies' viewpoints relating to the possible private offer of jobs and cash bonuses to Tinselton companies directors by Walrich companies. Private offer of jobs and cash bonuses to the subsidiaries directors. So it's private offer of jobs. Ethical consideration. Financial consideration is good. By after acquiring subsidiary employees will be familiar with their previous directors. So if they see that their previous directors are still managing the company, they'll be okay. They'll be happy. That's the financial situation. Ethical consideration, yes, employing them is fine, but private offer is where you have some dealings behind the scene. So ethically, there will be problems there. We'll have to discuss that on an ethical perspective, on a very moral perspective. So doing questions are good, especially read these theoretical questions so that you will have an understanding of what sort of discussion the examiner has on theory. Okay, always keep in mind, as usual, 50 marks of the paper 40 marks comes from theory, 40 marks computation, remaining 20 professional marks. Good, that's it. So that's it on this paper. First and second question I did not touch because it's not based on interest and foreign exchange risk. So in our revisions, I'll be focusing more on forex, interest rate, as well as options. If you discuss options specifically, we might have to use the BSOP calculator. So that's very simple. If they have asked BSOP calculator, they'd ask compute the value of options, call or put options, you take the BSOP calculator. It's very easy. So those are the three areas I'll be very much focusing on during revisions. Right. Any questions on today's question? Hassan? Yes. So keep in mind when you're doing questions, always when it comes to interest rate risk, especially interest rate options, if it's a normal interest rate option, it's okay. But today's question was an interest rate option with a collar. So there we had some differences in computation, two main differences. One is interest rate collar. You have both a maximum cap and a minimum flow. So you buy both put and call option. We are going for both. Even though it's a loan or a deposit, we go for both put and call option interest rate collar. Second is how the premium is calculated. So those are the two differences in interest rate collars. Take a note of that. In exams, very rarely they touch interest rate collars. They will normally give it as a general question, or a cap or a flow. Cap and flow is also normal. Interest rate collar is something unique. We go for both cap and the flow. So it's a good question where they have touched upon this particular niche area. The exam, you might also be, you can also expect an interest rate risk to be tested. All right, since that's the case, we'll wind up our session here today. So for the remaining 2 to 3 more sessions, I'll be touching upon the interest rate and foreign exchange risk questions done in the previous mock papers and past papers. The rest, if you have any concerns, you can always drop me a text privately. In other areas, investment appraisal, business valuation, working capital, you can always contact me. I don't think you'll have major problems there. I'll help you out separately. And those doubts can also be discussed during our next session, next revision session. Okay, guys. Then let's wind up. I'll see you next Wednesday at 6.